Good afternoon. Delighted to be able to chair this final session of the day. For those of you I haven't had the chance to say hello to, I'm Caroline Price, and I look after the Nature and Environment team at the Crown Estate. I am really excited to be chairing this panel about this really important topic, about, I think, which we've seen quite a lot of change in recent years. I think I was discussing with colleagues over lunch, actually, how it feels like it wasn't that long ago when we were talking about habitat restoration, trying to pull through funding for nature recovery, and all those conversations had to be about either philanthropic money or public funding, and there was really no conversations happening around how we could bring and grow the amount of private finance that was flowing into habitat restoration. So we've seen exciting progress in some ways on that front in previous years, but as the title of this session suggests, still quite a long way to go. So I'm very excited to have the opportunity to have this panel with some really experienced and expert people who bring quite a diverse range of views from across this topic to lead us then into a panel discussion about how we might overcome financial barriers to scaling nature-based solutions and restoration. So I'll hand over immediately, without further ado, to the first speaker, who is Elizabeth, who many of you know already, to start us off.
Thank you, Caroline, and good afternoon to everyone. Really glad to join this discussion as well. So those of you that don't know Finance Earth, we are fully focused on mobilizing private capital for nature, climate, and communities. So joining a panel on overcoming the barriers to mobilizing finance for marine and coastal restoration is very core to everything that we do. And as I shared Caroline's perspective on that, there's been a lot of great progress over the last few years. Rightly so, because it's very much needed. I know you have spent a lot of the day today talking about some of the statistics, and so I don't need to go through these. Everyone in this room is very well aware of these, but obviously the scale of the challenge is huge. And the amount of finance that needed is significant, and it won't be covered with public money alone or philanthropic money alone, which has been where most of the funding for marine and coastal restoration has come in the past. And so in order to mobilize the amount of funding needed, an estimated between 44 billion and 97 billion of additional funding over the next 10 years, to close this gap, we have to unlock private capital. And one of the ways to unlock private capital is to look at the new and emerging business models, but also some of the business models that have existed for some time that can help to drive private capital into marine and coastal restoration. So when I talk about business models, what am I referring to? Business models are really about what are the ways in the marine and coastal environment where a business can operate to generate revenue. And then that revenue is a way to then bring in private finance. So this graph is meant to show you the kind of difference between those business models in terms of their level of development, their level of scaling, and their ability to actually mobilize repayable finance. So as you see, as you go across what we call the J curve here, a number of these markets are still very nascent. So a number of the business models very nascent. So around things around biodiversity, for example, still very nascent, although growing in a lot of interest. And I know Sophus is going to talk about that in the next session. But also some are much more established. So for example, I'll talk a little bit about supply chain payments, but also sustainable enterprises. So really just to say, you might have one idea, so that marine natural capital is just biodiversity, or we're just talking about blue carbon. But actually there's really a range of business models that can work to drive more finance into marine and coastal restoration. It's really important to think about the range and how we might combine various business models, because that's where we see the key of where you can really be looking at multiple ways in one seascape or a seascape and landscape, so that you're looking a bit more holistically about the various business models that will be needed to act together to really mobilize the finance that's needed. So the barriers this session, as Caroline said, there are, a number of barriers. We still aren't seeing the amount of private capital flowing that we need to see to really address the challenges at hand. The good news is these barriers come from some of the work that we've done with a range of partners like Crown Estate and Blue Marine Foundation, Esme Fairbairn Foundation, and a number of others in the room today, around looking at what are those barriers and how can we address them? So some of the barriers have been around that lack of consensus around the prioritization of where to prioritize marine and coastal restoration or protection. Limited track record of pilot projects. So often the pilot projects that we have seen happening are either at a very small scale, or the evidence around the outcomes that they've delivered haven't been as apparent in some cases. The good news is that most of these barriers are being addressed, and a number of them, even since we launched the roadmap, which I'll come to just a year ago, we've already made progress on addressing a number of these barriers. I want to speak specifically about demand drivers as one of the key barriers. So that's a real crucial one. So where there isn't demand to pay for environmental and social outcomes that are delivered through marine and coastal restoration, there will be no private finance mobilized. So that is the crucial factor here, which is there's a number of ways where we can drive further demand that can come through regulation, as we have with terrestrial BNG, for example. We can have more regulation, which is mandating that corporates or other actors need to be buying or supporting the outcomes that are delivered through marine and coastal restoration or protection. The other is through voluntary initiatives. So like we've seen with net zero and SBTI commitments, or as we've seen with the Task Force on Nature-Related Financial Disclosure, those voluntary initiatives can drive corporate action to say, okay, we want to be reporting, we want to be showing our customers, our investors, that we are taking seriously our commitment to show more positive change on either climate or nature or social objectives more broadly. But demand is really crucial. So I'll come back to that as we go through the presentation and the discussion, but I just wanted to highlight that. Data and evidence gaps, that's one where there's been a lot of work. And so actually, I think this is one of the areas where we are starting to see a coalescence of where that data is then held and shared and in a way that can be more used by projects and communicated as well to corporates and investors that are engaging in this space. Another key barrier I wanted to just stop on is around skills and knowledge. So capacity, and who has that capacity. This can, take a variety of forms, but when we're looking at marine and coastal restoration, where does that knowledge sit? Is it within the communities or the places where there's the priority for restoration, or is it somewhere else? And so making sure that there's that knowledge and capacity in the places where those actions need to happen is really crucial, and also making sure that there's wide buy-in. So when we say, if there's going to be large-scale restoration in a particular area, that the community is thinking about how they will benefit and building the project around to ensure that the community does benefit, and there's ways to structure that. But making sure then that community organizations understand what the opportunities are here, how to develop projects that are going to actually speak to what corporate buyers want and can then actually mobilize private capital from investors. So that's a crucial piece as well. So as I said, these barriers were identified through work that we did in partnership with a range of actors, many in the room today, on developing a roadmap for high integrity marine natural capital markets in the UK. And we set out over about a year time to understand the key barriers. So we held workshops throughout Northern Ireland, Scotland, Wales, and England. We consulted with more than 200 organizations around barriers, but then also on the actions that were needed, and set out a roadmap which included a range of recommendations. So the key recommendations, the associated actions within those recommendations, and the key stakeholders experts to implement those actions. So we wanted it to be as practical of a guide as possible that people could pick up and see themselves in and say, okay, this is where I fit in, and this is where I can do something. And we launched it last year in May, and as I said, a lot of those barriers are already being addressed and actions underway, which I know have been already discussed earlier today in the program, and we'll hear more about tomorrow as well. But just to run through those priority areas around identifying the priority opportunities and approved methods for marine and coastal conservation and restoration. So again, coalescing around where are the areas where we want to be focusing attention. Delivering seascape scale projects, so to show that actually these are demonstrated ways where we can mobilize private capital to support marine and coastal restoration. Implementing the policy and regulatory requirements to drive demand, again, that demand piece being really crucial for this all to work. Accelerating the development of UK-wide codes for marine and coastal ecosystem services. So again, this is about the high integrity piece. How do we know that actually what the outcome that a project is delivering is really delivering that outcome? That's about setting out the methodologies and the standards that say, this is the science behind how you measure that outcome. And we all agree that that's actually delivering what we're setting out to achieve together. Addressing the evidence gaps, again, around data, building the necessary skills and capacity to harness marine natural capital opportunities. A number of exciting initiatives have already been underway over the last year to build that capacity in different communities and with different organizations. And developing publicly accessible and standardized approaches to data collection, hosting, and monitoring. Again, that data piece being key for then the reporting on the outcomes that are being delivered. So I'll just run through a few quick case studies, again, around what we've seen over the last year and a half or two, as Caroline was mentioning, a lot of positive things happening, a lot of projects happening, and so a lot of learning coming out of those projects. So we've been working with Dumfries and Galloway in Scotland. The project's called SCAMP, which is about looking at combining habitat restoration, community enterprise, and market-based funding to support basically unmanaged realignment on 2 working farms and assessing then what would be the costs of that type of restoration. Often with other salt marsh projects with managed realignment, the costs can be quite high, and the current price of carbon credits that you could get with salt marsh credits sold from that wouldn't make the project viable. But here we looked at non-managed realignment, as I said, on working farms where there was the potential to combine payments from within the value chain, so within the agricultural value chain who have a Scope 3 emissions reduction target, so to pay for the carbon that's being sequestered through the salt marsh restoration, and also then be combining that with other payments that they could receive around biodiversity and otherwise. So looking at then how that combination could really make the project viable. And that's where we see, as I said, the real need is to look at where you can be combining different business models. We also looked here at community enterprise model in oyster bed restoration in one of the most economically deprived communities in Scotland there, and what can be done around transferring some of that oyster bed management and restoration to the community there, and then developing local enterprises around stalls and restaurants, etc. So again, I think it's the key point to underline here is that it takes a combined approach to really make these things add up and be viable. Another area we've been working is in Plymouth and the establishment of Ocean City Nature, which is a central vehicle whereby Plymouth City Council has led this, and it is one of the first habitat banking vehicles and covers both green and blue areas, and so both terrestrial and marine related. And we've been looking at the possibility of a seascape token. So looking at where there's not yet a code or a credit or a unit that can necessarily be sold. Is there a way to look at area-based funding models? So building on a type of what 3 words or 3x3 unit linked to marine restoration preservation, where then as with the purchase of that unit, you would get a report of the outcome linked to that area. So the report could be around the carbon, the biodiversity, but also the wider impact that's being achieved in that area, and could be sold as tokens. So that's an area where we see a lot of potential, particularly with some of the more nascent business models, as I mentioned, to support the research and data collection that needs to happen to then move up that J-curve. Another area, people don't often think of fisheries as a part of marine and coastal restoration and preservation, but we think it's an integral part. And again, looking at the various business models that can work. A few years ago, we established a fisheries improvement fund, which we've now been looking at how we might support fisheries improvement in the UK. We have a first project launched in Chile, but this is a collaborative approach. Again, a key point I think that's needed is finding ways where you can identify a shared issue for multiple actors. They could be in the same sector, like here in fishing, but they could also be in different sectors. So offshore wind and fishing, for example, you might looking at their shared need or interest in reducing bycatch or ETP species and effect on birds. That's a way where you could then be solving a shared problem for a range of corporates, pooling money so that the cost to address that issue is less for those corporates, and then really driving collective action there. We see a lot of potential with this to address a range of issues. We've been also looking at how the fund could support and scale gear and technology adoption in fishing that would address a range of issues, including bycatch, but also the seabed disruption and improved livelihoods, electronic monitoring on vessels. And often the key issue there is that the gear or tech might be too expensive for a vessel owner to adopt on their own. So where the supply chain can pay or subsidize part of that cost, we see a lot of potential to then increase the rollout of a lot of promising gear and technology that will have an immediate impact in the marine and coastal environment. So just in terms of key learnings across some of those case studies that we said as we think about this session focused on overcoming barriers, some of the key things we've learned. Demonstrating those projects. I think someone at the end of the last session was talking about how do you ensure that those learnings are shared. It's about, I guess, conferences like this, but also making them publicly available so that we're all able to learn from each other and really then help drive the speed and scale that those are adopted. Looking at supply chain integration, as I said, the demand piece being crucial, where you can look at multiple corporate actors, whether across different sectors who might have a shared interest or need in a seascape or an area, and designing then the interventions that can meet them. That's a way to then be able to engage and drive more funding and build scale there. Central governance and a centralized funding vehicle, like with the Plymouth example that I gave, we feel it can be really useful in terms of strategic coordination. Often what we've seen in this area is that there's a lot of different information happening or different conversations or different approaches. And so having centralized mechanism whereby buyers or corporates interested in that area can engage can be really useful at streamlining things and again achieving that scale. And then around some of the most successful models we've seen and we think that have the most value going forward are where there's those multi-stakeholder collaborations. So as I said, again, across sector, but also looking at where you're building in community organization, either ownership or direct benefit and involvement in the design and delivery of these projects. And of course, enabling regulatory frameworks and regulation are really the key to driving demand in this area. So thank you. I'm very much looking forward to the discussion and hearing from the next panelists.
Thanks, Elizabeth. And yeah, I should have said at the beginning, sorry, be writing down your questions to have at the panel when everybody comes back. So I won't do questions for Elizabeth now, but when we come back together at the end. So I think really interesting overview of kind of where we are in terms of progress around nascent and emerging marine natural capital markets and the way those market mechanisms are potentially helping in terms of the scaling side of things. But I think what we should think about as well as part of this is what we can learn from kind of more established markets and what's been happening elsewhere, whether it's beyond the UK, elsewhere in the world, but also what's been happening from a terrestrial point of view, where some of these conversations have been happening for a bit longer. And so handing over now to our second speaker, who can share his extensive expertise on that.
Super, thanks so much. I've had a really great day. It's been such an interesting event. I was just saying, like, I've learned more in the first half of this conference than I have in like the last 2 months of my actual job. So it's just been really great. Today I was asked to come and give a talk. So I'm the nature finance lead at the University of Oxford's Nature Positive Hub. So I co-direct like a biodiversity finance research group with Professor Joe Bull there. So we're a team of about 10 people who basically studies biodiversity finance, mostly for-profit private biodiversity finance and a little bit of public biodiversity finance as well. And basically our work can be split into 2 major themes. One is how do you scale up private investment? And the other one is how do you make sure it's actually good? So those are the 2 major themes. I think both of those things are really important because we've seen a lot of systems, a lot of nature credit systems that have successfully scaled up private investment but actually done nothing for the environment. So it's really important that both you have the scientific rigor behind these credits to make sure that they actually mean something that's actually meaningful, and also that we create the demand drivers to scale these things up. Those 2 things have to go hand in hand. So the big picture here is we're talking about how we scale up finance today, but we're basically talking about the wrong issue. Right? What we should all be talking about is how to scale down damaging finance. Right? So this is a figure from the United Nations Environment Programme's State of Finance for Nature report. Basically, what it shows is that we've got $7 trillion worth of damage to the environment every year, mostly from private finance, so that's profitable business models that destroy the environment as part of their business model, but also a huge about $1.7 trillion in public subsidies for stuff that destroys nature as well, right? So your taxpayers' money is funding stuff that destroys nature all the time. And it's doing it for other kind of geopolitical strategic objectives, like, for example, achieving energy dominance, right? So your public money, your taxpayers' money is going into stuff that destroys the environment for other public policy objectives. Now, we're talking today, or in this session, about the total flows into nature-based solutions. Of those, well over 80% of them are actually public money and have historically been public money. So it's only a tiny fraction of that is private money. And of that private money, what is the actual private finance going into? Well, there's basically huge definitional issues here. So it's actually really hard to know what this number is. In terms of the things that we might call biodiversity finance, the specific biodiversity-related credit systems, it's about $12 billion a year, and nearly all of them are in the United States under the US wetland mitigation system, okay? So that's the scale of what we're talking about here. About $12 billion a year of for-profit investment in nature credit type systems. Things like the International Voluntary Carbon Market, which you might think are a really big deal, are actually tiny relative to major markets like the US wetland mitigation system, right? So that's the picture here. So we're talking about a tiny slice of a tiny slice of a tiny slice, and the real issue is that our entire economies are hardwired to create profitable business models from stuff that destroys nature inherently, right? So that's where our focus should be. But that's not where I specialize. Academics specialize in their tiny things, so I ended up specializing in these nature markets, even though I think that actually they're relatively unimportant, right? So the whole term nature finance is basically misleading. If you actually go into what actual investments so-called nature funds are actually investing in, they're basically sustainable agriculture, agricultural technology, a little bit of forest management, and a tiny bit of carbon, right? So that's basically, this is a really useful paper that came out a couple of years ago that actually went in to look at the actual investments of so-called private nature funds by for-profit financial institutions, and just the headlines here are just really important. So firstly, not all nature-based solutions are equal from a finance perspective. Most existing nature-related investments are in established economic sectors that deliver well understood and attractive commercial returns, right? So that means they're doing normal stuff, and some of them are being labeled as nature finance. Secondly, the lack of ability to monetize adaptation-related benefits does mean that projects are skewed towards those that deliver either traditional commercial revenues or carbon-related returns. So again, what we call nature finance is actually like what finance just calls land management, basically. And then there's a tiny little bit of carbon-related investment, right? Biodiversity basically doesn't even feature here. Okay, so that's the overall landscape. So I'm going to basically tell you what I think we've learned from my last 10 years of research with collaborators and stuff, Basically, these are the kinds of evidence that our work is drawing on. First two are basically reviews of nature markets, right? Next two are evaluations of actual nature markets, the English biodiversity net gain nature market and the Victorian native vegetation offsetting market. So these are big, internationally renowned nature markets. And the last two are our work, the next one is our work to try and define what a scientifically credible nature credit is. And the last one is our work talking to investors to talk about how you can scale this stuff up whilst maintaining their integrity. And basically, so big bundle of evidence, and here's the things I want you to take away. Right, so this is what my interpretation of the last 30 years of academic evidence in nature markets. All right, first one, common perception, or I would say misperception. Markets are more efficient or effective than direct public investments in nature. Right? Intuitively sounds true. That is what a lot of public policy discourse says. Now, we've actually evaluated the outcomes of a bunch of nature markets around the world, and basically one of them has been really quite effective. Right? So the US wetland mitigation system has delivered very high rates of additionality. It's created a lot of wetlands that would not otherwise have been created. Those wetlands are in a pretty crappy condition. So if you ignore condition, they've been very effective. They're not a very high condition, so they're not equivalent to those of natural wetlands, but they are at least doing something. There's also probably around 5, 6 other nature markets where we've done academic evaluations of their outcomes, and all of those have done really bad jobs. Nearly all of those are things that are designed to pay people for protecting vegetation and stop them from clearing it, under the assumption that without that payment, they would clear it. Turns out they wouldn't have cleared it anyway. So that's basically how nearly all of the world's nature markets function. All right? Second misperception, nature credits are a new thing. They're not. They've been around since the 1990s. Okay. Next one, we have little scientific evidence on which to base their design. That's not true. We have a whole community of practice that lots of mainstream economics ignores that's been working on nature markets for 30 years. We have 30 years of academic evidence to draw on. We just don't get a seat at the table in how lots of things are discussed. One of the reasons for this is that there are some really complicated fundamental tensions between the needs of nature and the needs of an investor. One of the reasons ecologists don't get a seat at the table in lots of these discussions, partly is because we don't understand the right terminology, but it's also partly because the stuff that you need to do to make stuff good for nature, the kinds of checks and balances and safeguards, add additional costs that make them unattractive to investors. So there are some fundamental trade-offs that need to be resolved. Yeah. Next misconception, the hardest thing is how to measure nature. So if any of you are following the international voluntary biodiversity credit world at the moment, we have the proliferation of well over 40 different types of biodiversity credit methodologies. I think they're all answering the wrong question. Right? So what the evidence of the last 30 years tells us is that you can create any old random way of measuring nature. You can commodify nature in any way you choose. Different schemes do all sorts of weird stuff, right? You've got the US species banking system, which basically just measures the area of habitat where a species is thought to exist, right? That's the thing that they've commodified, right? Or the international voluntary carbon market, they've commodified keeping trees standing in areas where they may or may not have been cleared anyway. So I'm telling you, it's a complete social construct how you choose to measure nature. But the real difficulty in nature markets is not the thing that you measure, it's how to make sure that thing actually happens. So the real issue is how to ensure compliance, not what you choose to measure. Right? That's my opinion. Another major conception, if you create a kind of nature credit scheme, then the money will flow. This is, I think, completely misguided. The money flows only if there is a driver of demand, especially a mandatory driver of demand. So if we look, for example, at that 12 billion of investment in nature credits around the world, right? How much of that is voluntary? Well, the international voluntary carbon market generates about $500 million a year of investment in nature credits. So the other $11.5 billion is mandatory policies that force you to buy credits. So basically, money flows only if there is a demand driver. Voluntary markets have historically just not done much. And the last one is, if you generate a revenue stream, you'll get large-scale institutional investment. This is a really important one that I think probably the main one that ecologists have misconceptions around. That is absolutely not true. To attract mainstream commercial investment, you need to deliver a product that delivers a mainstream investor the same kind of risks and returns as a mainstream conventional investment, as a US tech stock, right? That's what you need to do to attract mainstream institutional investment. So a paper came out last year, basically the first paper that is really, really good empirical evidence on on the actual, individual investments of a for-profit, biodiversity-focused private equity firm. And they show that in their portfolio of investments, the average internal rate of return is 14.7% a year, right? So it's not enough to generate a revenue stream, you need to generate an incredibly profitable revenue stream in order to attract mainstream institutional investment. Now, one of the main counter-arguments here is, okay, so then blended finance. So then we need to de-risk these private investments using public money to pull some of the risks out so that investors will accept a lower risk-return ratio. That is absolutely true, but you've still got to make them really profitable. And so in this paper, even with government de-risking, the amount required to attract mainstream private equity investment was still 12% a year, right? So that's even with de-risking. So, how do you upscale private investment? Again, this is summarizing a lot of research from our group, but 30 years of others' research. As Elizabeth said, everything else is kind of nonsense. The main thing is you need a driver of demand. What the conservation sector does is, in fundamentally misidentifying the financial sector, creates millions of products with no demand. Whereas if you look at all the markets that have scaled, they created a demand and then millions of products to solve that demand. So the great example, again, is the US wetland mitigation system, by far the world's largest nature market. What happened? Well, a regulatory change that led to a change in legislation for the country to then achieve an overall objective of no net loss in the acreage and function of wetlands. And then, it took about 10 or 20 years, they created credit mechanisms for satisfying that existing regulatory demand. Not the other way around. They didn't create the credit and then the demand. No, the demand came first and then they solved the demand problem. Okay, next one. A massive risk to cash flows when you derive your revenues from a nature market is policy risk. We are living this in the UK right now. So policies for encouraging finance cannot address fundamental policy risk. So what I mean by this is, if you are creating a nature project and the revenues that your nature project is deriving are selling credits into a mandatory system that is caused by policy, your risk is basically that the government will take that policy away. And so the only thing that can satisfy that risk is you can't de-risk it. It will always be an enormous risk to an investor until an investor has confidence that that policy is here to stay. So what you should not do is what the UK government is doing, which is every couple of years try and repeal our nature markets, because it gives investors absolutely no confidence that those things will exist and generate revenue streams for the foreseeable future. Okay? So for reference, within the last 3 years, the government has introduced and then tried to withdraw our nutrient credit market, introduced and then created a complementary public policy mechanism that undermines our biodiversity net gain system, and last week has consulted on basically stripping away 70% of demand from our biodiversity net gain system. So all of these send huge demand shocks into our system. Next one, enabling policy needs really good coordination across governments. So this is also very interesting. We've got siloed governments and doing public policy. I criticize government a lot. All of my experience of working with individual civil servants has been they're absolute legends, right? These people are way better at their job than I would be in their situation. They just do a really impossibly hard job, which is trying to make something work with their hands tied behind their back, right? So the problem is not civil servants. The problem is that a government is trying to achieve loads of contradictory geopolitical objectives, and those things tear at each other. That's the problem. Now, this also means that there's loads of government policies that aim to create and scale nature markets, and at the same time, loads that undermine all of those things. Right? So the way to scale nature markets is to coordinate across all these different policies so that you don't create them on one hand and destroy them with the other. So like a really interesting high-level one is with the European Natural Capital Financing Facility, so a major European investment bank fund for investing in nature. They basically wanted to invest in for-profit conservation projects, but for some of the projects that made it through their entire due diligence process were great projects for attracting private finance, and at the very last minute they got grant money. So then they just left the whole portfolio pool, right? Because they were undercut by an alternative government program that then offered finance but without having to be repaid. Right? So these kind of coordination that means that we need to coordinate across policies so we direct the right types of finance into the right types of investments. And there's loads of conservation that can't be funded through private money because it can't be commodified, and that should be the target for public finance. And then there's loads of conservation that can be commodified because it's delivering something that is aligned with the needs of investors, and that could be the target of private finance. But we've got to make sure that we understand which those things are. This is a really important one. It sounds technocratic, but actually it happens weirdly often. Don't introduce multiple pathways for a project or a firm to achieve compliance, and then make a market one of those pathways, but make that market more difficult to use than the other pathways. So this is a really weird thing where a number of governments have basically made it mandatory for you to offset your impacts, but they've said, if you don't want to purchase it through the offsetting market, you can either pay us directly instead, or you can do it yourself, and we won't check if it's done properly. And I mean, this sounds kind of weird, but we do that in the US and the UK. So two of the world's largest natural capital markets have that exact approach. So they actively create the market to satisfy a demand, and then undermine its demand by saying that you can do it under an alternative governance pathway that we won't regulate. It's really strange, but this happens all the time. Now, the last one, the specific nature of conservation projects, which is they deliver long-term revenues that are highly uncertain and intangible non-market goods often, means investors won't invest unless there is some form of certainty. So this is where the demand driver comes in. If the government doesn't provide this uncertainty, it doesn't mean that these projects are doomed, because there are other ways of providing projects with certainty. I think philanthropy is going to play an increasingly large role in these systems by providing advanced market commitments, which is basically you tell a project, if you create credits and they're credible, I will buy them at this price. And that can create a cash flow that an investor then actually has confidence in, equivalent to that caused by a mandatory market. So that was all on the kind of the highlights, the takeaways from the last 10 years of our research. We've got this paper that's just in review now, which is on the scientific credibility side. So what we've done is I've worked with basically the people who've led evaluations of all of the world's nature markets for which there's been an academic evaluation. So Tom Swinfield's International Voluntary Carbon Market, Joe Bull is like the legend of biodiversity offsetting, Nat Duffus has led an evaluation of biodiversity net gain, Andrew McIntosh and Megan Evans have led evaluations of the Australian native vegetation carbon offset market, Martine Maron is like Australia's greatest biodiversity offsetting expert, Sebastian Theis has led an evaluation of the US wetland mitigation system, and Tom White has led an evaluation of the US species conservation banking system. So we've got people here who've led evaluations of nearly all of the world's nature markets, and we've tried to pull out, what are the things we've actually learned from all of these evaluations? What are the golden rules for creating nature markets that are scientifically credible? And this was the 5 dimensions that we got together and we came up with. Basically, the first one is make sure the thing that your nature market is measuring is actually the right thing. Because often they optimize for something that's actually not the thing that you want at all, which is weird. They optimize for, or they measure something that's convenient to measure, but then further rigorous science shows that the thing that was convenient actually doesn't correlate with your outcome at all. So that's an issue. Second one is really important. Assume non-additionality unless proven otherwise. So traditionally what nature markets do is they say, all right, we want to buy your nature services. If you opt into this market, we'll buy them. And then they kind of, in some kind of policy legislation, they assume, or they create some simple rules to determine whether or not that financing is additional. So it's financing a project that would not have gone ahead anyway. What we're saying now is that if there's one lesson from these evaluations, it tells you if you design your policy like that, you will pay people to do stuff that they would have done anyway. That's a repeated lesson from these things. We can talk more about how you solve this after. Restoration-based systems are much, much more likely to be additional than protection-based markets. So that's one thing. But it's still not a dead cert. One of the world's largest nature markets is the Australian land-based carbon market, which is a restoration-based market which had no additionality. It's an absolutely crazy system where they basically pay people to remove cattle from their rangelands on the assumption that trees would regrow, said the trees would regrow, but then they actually gave carbon credits to places where trees already were. So a restoration-based system does not guarantee that your crediting mechanism is additional. Right? Next one is assess and manage leakage. We put this one as one of the scientific frontiers because we actually haven't cracked how to deal with this one yet. But basically the idea here is if you implement a nature market that restricts some kind of economic activity in one area, you can be damn sure you'll displace that economic activity somewhere else. And if you're not accounting for that in your system, your market might have no overall outcome. So in the context of fisheries, in the context of the marine realm, this might be something where if you implement a nature market that restricts fishing in a particular area, you've got to account for the displaced fishing effort, right? And only if you properly account for that can you say that your market will deliver overall good outcomes. In short, independent verification seems really obvious, seems really intuitive. Nature markets that we are still creating right now have no transparency. absolutely wild, right? The biodiversity net gain system, so England's domestic nature market, one of our flagship environmental policies, right? Over 90% of it has to be accessed through over 200 individual government websites. So you can't even tell what's going on in over 90% of our market. Right? And that's just appalling, an appalling level of transparency after 30 years of trying this stuff. And then last one, you need to ensure that you can guarantee the long-term compliance and enforcement of these systems, which means that after 10 years, right, if you've signed up to deliver a nature credit, if your project is deviating from its predicted outcomes after 10 years, you have some kind of system in place that will detect that and make sure that you deliver that outcome. Because again, what we've seen is that compliance rates in nature markets, especially a few years after the initial payments have occurred, actually calamitously low, really, really low. So this long-term compliance and enforcement, I actually think is like the big issue. Okay, I had a bunch of other things I want to say, but actually I'd rather leave time for discussion. So thanks very much. Right.
Loads of opportunity to do better then, that's what I heard. So on that note, I'm going to ask Kaija to come and talk to us about her experience and the experience of the team working in the Solent Seascape project in trying to bring these things to life through a real life set of projects and with a really diverse community of people that they're working with to see if we can make things work and drive some positive outcomes.
Thank you very much, everyone. I'm Kaija Barisa. I'm a senior economist at Blue Marine Foundation. I'll be chatting about the sustainable finance work we're doing as part of the Solent Seascape project. You've heard of the many, many barriers to achieving nature markets. You've heard of the many reasons these nature markets that do exist are fluffy and airy and not fit for purpose. And I'll talk about how, against all odds, we are trying to make it work right here in the Solent. So I won't go into this too much because you'll hear tomorrow from Louise and Luke, my amazing colleagues who are working on the Solent Seascape project more broadly. But the Solent Seascape project is a multi-year, multi-million-pound, multi-habitat restoration project. These are just some of the many, many bits going on, including community engagement, a huge and impressive monitoring program, restoration programs, and really behavior change programs trying to restore habitats in and around the Solent in the long term. You'll see up in the top corner that 3. I'm going to be talking about that tiny little box up there, which is one of the many, many, many tentacles of the Solent Seascape project, where we are trying to develop a sustainable finance mechanism to be able to continue all of these other programs in the long term. So you will all know this. You get ecosystem services from the seascape. And ecosystem services are different benefits that the seascape can provide to people. Some are more economic, some are about well-being, some are aesthetic, some are easier to measure, some are harder to measure, but this is just a list of a few ecosystem services that we're expecting to see and that we're expecting to see increase over time as we improve the seascape around the Solent. I've put biodiversity as an asterisk because it doesn't necessarily fit into an ecosystem service, but it does encompass almost all of the other ecosystem services. And again, this is not an exhaustive list by any means. As part of the Solent Seascape project, we are focusing on these 3 specifically, mostly because they are slightly more straightforward to monitor, mostly because they're not necessarily linked to extraction like fisheries, and because there are, in some cases, existing markets for these different ecosystem services. But there are associated benefits and challenges with all 3 of these. So with carbon for the marine environment, particularly in the UK, you've heard a lot about how we have pretty fragmented blue carbon ecosystems that are all, not doing their best. So it's actually costing more to kind of develop carbon mechanisms and carbon credit mechanisms around the UK. So it's not necessarily yet feasible unless we develop and work on domestic codes, which I know actually people in this room are working on. Nutrients, we will have also heard from people that it's a very murky, excuse the pun, very murky challenge at the moment, particularly because it's often a terrestrial problem that is having negative impacts in the marine space. So figuring out how to credit something like that and how to use the marine environment to credit against negative impacts on land is really tricky, and it can lead into some complicated and convoluted routes. Biodiversity, and so ironically, biodiversity, which is the market that doesn't really yet exist, and the ones that do exist do not exist for marine environments, and the ones that kind of are floating around the marine environment are incredibly early days. But besides all of that, that's the one that we've decided to narrow in on at the moment for the Soul and Seascape project. So about 2 years ago, the Soul and Seascape project was selected by Plan Vivo, who are traditionally a carbon credit standard setter, to pilot a new nature certificate methodology. They call them certificates. I'm going to call them credits, but in the methodology, they're called certificates. And we were selected to kind of help build a methodology, test their methodology, and see if this kind of new nature markets methodology is fit for purpose in the marine environment, and particularly in the Solent, where every complexity that you could have of a marine restoration project is there. You have, millions of people. It's a busy waterway, multi-habitat restoration, many different types of species, many users of this space. So we really gave them quite a challenge to be working with. And crucially, there are different types of biodiversity credits that we're talking about. Crucially, I'm going to start with what they are not, is these are not offsetting credits. So these cannot be used to offset negative biodiversity impact. Again, these types of credits exist. They can sometimes work, as you've just heard from Sophus, but there's just a bit of complexity and a bit of a murky space of whether we'd want to engage in a market like that. So these are nature positive credits. These are not sold without being verified. As you heard again, just in the previous presentation, being third-party verified is really, really important because it allows for transparency throughout the market and for both the project and the buyers and everyone involved to know exactly what it is that they're buying. And at the moment, they're not commoditized and tradable assets. So that's what they're not. What they are is, again, independently certified and verified credits. They represent real additional verified biodiversity outcomes. They represent 1% uplift per hectare per year. And we want these credits to be led by local communities, by Indigenous peoples and local communities in the area, and we want the credits to be benefiting, and this type of market to be benefiting these local communities. Again, we've heard a lot about this. We want to ensure high integrity. We've done a lot of learning from the carbon markets of what not to do, so we've done a lot of thinking about what to do, and we as in the whole biodiversity credits markets atmosphere. And so we want to ensure that there's a holistic impact, it's evidence-based, it's scientifically informed, and it's fair and equitable benefit sharing for the communities around these projects. So these are 4 really crucial elements, again, that were already fundamentally built into the Soul and Seascape project and will be built into our credits that we are developing. Initially, we had a very big ambition to create credits across the entirety of the Solent. We quite quickly realized that that was going to be one hell of a feat. So our new trial site is this 120-hectare area around Itchener, where we are doing different habitat restoration, so oyster reef and salt marsh. There is a seagrass area, and there is actually a seabird restoration site, but there are some complexities of including that at the moment. And so it's an area where we're going to be monitoring across taxonomic groups, doing annual random sampling. We're going to be looking at different habitat types, habitat health, habitat extent. It's an incredibly complicated and robust methodology, but it just goes back to the fact that we want this to be evidence-based and science-led, and we want to make sure that everything that we're reporting on the biodiversity uplift is coming from science and from evidence, and from our amazing monitoring team that know what's best and how best to represent these ecosystems. So alongside looking at how we're going to monitor what we're going to monitor and the methodology and that nitty-gritty, we are also working on the demand side. Again, as you will have heard in the last 2 presentations, you can't just create credits and hope for the best. So we are actively trying to think about where these credits are best placed and how we can ensure that there is demand for these credits when they are created. We've done a lot of market engagement surveys, we've spoken to corporates, we've publish reports on what they want, what they're looking for, what they think a biodiversity credit is. And we've kind of come down to these three different use cases for the biodiversity credits that we think will be pushing demand for them. So that's reputation, regulation, and risk. So starting with risk, risk is actually a really big one, and it's the one that probably is associated with the most economic value, and it's about value chain creation and risk mitigation and just the dependencies on biodiversity. And you can see there's a stat that the UK economy would face damages up to 15 billion by 2050 through the loss of specifically coastal ecosystems. So that's a huge hit. But restoring and protecting these habitats can be valued at 6.2 billion in those ecosystem service returns. And so investing in these nature positive biodiversity credits can help you mitigate these future risks of leading to that 15 billion a year cost. The next is reputation, and this is definitely the one that is currently the most likely to be the driver of demand is, we hope, and slightly losing optimism in that consumers want to see corporates and the private sector be better. And we're not talking about just kind of reversing biodiversity loss and halting it. We are talking about actually restoring and adding biodiversity back into the ecosystem. And you can see again a few stats that there is evidence to show that this is something consumers are looking for, and hopefully that can put some pressure on corporates to be investing into things like nature positive biodiversity credits. And finally, the key one, and again, agreeing with the two previous presentations, this is really hard to do without regulation, without mandatory drivers to push corporates and push the private sector to have to invest in nature positive. And unfortunately, we're seeing a bit of a backwards trend at the moment. The few frameworks that exist where we have to report on our impacts on nature are being revoked slowly but surely. But again, we can't lose faith, because without kind of forcing companies to have to commit to nature positive, you're not going to get that scale that we are looking for. All of this is to say, it's by no means do we have all of the answers for this, but we're really pushing hard down in the Solent to figure out what is the best way forward to creating these biodiversity credits in a multi-habitat ecosystem with lots of communities around it, and how we can create something that can be scalable across the UK and globally, because we think, whether it takes off or not, we want to make sure that we're in the room helping decide how to ensure high integrity and to include the marine environment in the room, because it's always left behind.
Thank you. I'd now like to invite all my speakers to come back and take a seat and if everybody can start thinking about questions that they might like to ask. I think we're going to switch to these lapel mics, so hopefully the audio will work for that. Really diverse range of thoughts shared, I think, to kick off this discussion. So thank you for that. And I think I'm going to take Chair's prerogative a little bit just to get us going, what people are thinking about questions that they'd like to ask. I think one of the key themes that came out from all of the presentations was around demand, the importance of demand, the importance of being able to articulate and understand demand, and doing that in a way that comes before creating the product that services that demand. So I was going to invite each of you to kind of just share a bit more and expand a little bit more about what you've seen happening perhaps most recently with the marine context, if you can, but not necessarily, because I think there's possibly some good things that we can learn from the terrestrial space where things have been going for a bit longer in particular, where you think actually this has been the thing that's really clinched the connectivity of the articulation of the demand and how that flows through into products. And what I'm trying to do there is separate out the point that you've all already made really clearly, which is that we need a regulatory mechanism that sits within that. That's obviously a clear part of the demand piece. But I mean kind of beyond that, if you can. Elizabeth, I'm going to come to you first.
Sure. Well, maybe I'll speak first in fisheries, because that's where we've seen quite a lot of traction, where we've seen, I'll speak to the gear and tech example that I was talking about, where there's been quite a lot of interest where the fisheries sector, so when I'm talking about retailers or buyers of fish or marine product, actually recognize that if they don't do something to either address the stock levels in the fishery or the damage to the wider marine environment, that they will have a problem, an economic problem. So they're coming at it from a risk and resilience of their business that they need to then act. And so a few examples in terms of supporting some of that tech that I've said, so that tech rollout, where it's not them investing in the tech. This isn't a tech venture. It's about actually the supply chain agreeing to pay, so that you can structure that in a number of ways, but a contract where the supply chain is paying for that, whether it's the adoption of a gear technology that's going to reduce bycatch, it's going to reduce the impact on the ocean floor, for example. We see a lot of traction with those kind of models because as I said, there's a real economic driver for those corporates to act. And there's a shared interest because you can combine the interests of a retailer with a fish company, with a vessel owner, with community organizations that are interested in that fishing sector thriving as well. So I think where you can add up those interests and really make it about, I've seen a lot of traction as well with the supply chain initiatives that we're working on with the resilience piece. So I think, you were talking about the risk of biodiversity impacts and the need to, and I think that message is getting across. And so there's a knowledge piece, I guess, for us all to be doing to make sure that risk and resilience piece is really coming across to corporates to drive up that demand.
Yeah, it's a wonderful question. I have a hypothesis, which is that all of these voluntary drivers of demand, including risk management, are actually just parasitizing philanthropy. So they're not actually creating additional investment. They're just relabeling something that they would have been donating to a conservation charity as a biodiversity credit or as a risk management measure. But I really doubt that these voluntary, and this is actually just completely unempirical. It's based on various conversations. So this is just a hunch. But I have a hunch that a lot of these voluntary drivers of demand are actually just taking things that 5 years ago we called conservation philanthropy and repackaging it. I don't actually think this is a bad thing because they are what I think these risk-related and voluntary biodiversity credit things are doing is much more rigorously measuring the actual impacts of conservation. So the way I see all of that voluntary stuff going is basically it parasitizes philanthropy. So it doesn't create additional investment, but it does professionalize that investment. And therefore, I can imagine it generating more and stronger conservation outcomes than it has previously done. So that's where I see all of that stuff playing a role. But in terms of generating additional demand, I don't see anything beyond. I don't see anything beyond regulation. There is the occasional really cool case study, right? So biodiversity finance. I spoke to an amazing nature-based solutions investor who described biodiversity finance. There's an interview on YouTube if you can see it as a public policy failure. So biodiversity finance shouldn't exist if governments were provided public goods adequately, right? So it only exists to commodify a public good, and basically in the Venn diagram between all of the value provided by that public good and the tiny bit of it that can accrue to a private recipient of the ecosystem services, it can commodify that bit. And hopefully that bit is big enough to justify providing the entire service, which is the public good. And there are a few examples where just commodifying that little bit of stuff that is actually of a benefit to a private beneficiary is enough to sustain the overall product, basically. So stuff that does really work, so that is this small section of stuff that makes commercial sense without having to have a regulatory driver, includes things like improved wildfire management, so improved forest management to reduce wildfires and protect infrastructure. That makes intuitive business sense. I'm tracking a very, very cool bond, which is the follow-up from the South African Working for Water investment, which is basically an invasive species removal bond. And the idea here is that actually utility companies are actually paying for the removal of very water-hungry invasive species because it increases water flow rates in water-stressed areas. So there's a tiny little slice in the Venn diagram where there is actually genuine, sort of voluntary or non-regulatory driven real demand because it improves operational business practices as well. That's where I think we should, I plan to spend a lot more academic effort working out what that bit is.
It's interesting. I'm going to shift the question slightly for you, Kai, because I feel like what we've just heard from these two already is that I feel like I don't want to kind of just say what's really complex, because that sort of feels like a sort of you're playing a get out of jail free card. But I think the complexity of it, I wonder if that's part of the barrier in terms of helping people to see the clarity about what's real demand, what's meaningful demand, what's helpful demand, and what is splitting of previous distribution of finance mechanisms. And I'm thinking about the communities of people that you work with in the Solent. And as you roll out the work that you're doing in the project and try to engage communities in the finance aspect of the project and help them to see and try and encourage them to work with you to articulate, well, this is how that benefit is going to come home to roost for me, and that's how it fits into a market-based mechanism or a finance model. I can imagine that that's quite complicated to do. How are you finding that? Or if you haven't really got going on that yet, how are you getting into that space?
It's a very good question. I'll just first very quickly come back to the point on taking the philanthropic money, because I don't disagree, but I do think it's finance that actually the private sector, they're being less philanthropic, and without a dressed up word like a credit or without a market mechanism, they're unlikely to give any funding at all. So it's rather than taking that funding away, it's repurposing it in a way, because, as you say, these are sort of outcome-based, verifiable, robust biodiversity outcomes. It makes a lot more sense to them. It's packaging in a way that makes sense with their kind of current ESG and CSR systems that they've set up. So I don't disagree, and I think those voluntary drivers still do push that forward, but then dressing it, and I think they wouldn't necessarily have put finance into it in another way, but dressing it in this way and reporting on it in this way is helping them kind of get into more philanthropic donating and donating for biodiversity. So yeah, it's an interesting one. On the community side, the Solent Seascape project as a whole has been doing and will be doing a lot of community engagement work around the science, the value, the importance of the marine habitats in the Solent. And the sort of benefit of the methodology that we're using is 60% of the value that we get from the credits must go back into the community. And that's kind of mandated by Plan Vivo, who are verifying our credits. So our kind of engagement with the community to prove the benefits of biodiversity improvement and the reason they should be striving for biodiversity uplift is incredibly straightforward. It's, you know, you get money to do community projects with this. I think the second thing is once that funding starts flowing, it fosters stewardship, it fosters kind of engagement with the project. And again, within the Solent Seascape project, they conduct volunteering days, citizen science, already trying to engage them in that way. So it's a huge effort because the Solent is not a small place. There are many, many people that live around there, many different kinds of people. And so figuring out who to engage and how is really tricky. But kind of a broad brush of engaging who wants to be engaged, and then working on this community benefit sharing financial system is a really relatively straightforward way to do that.
Nice. Okay, I'm going to open to the audience and see if anyone's got any questions they want to pose to the panel.
Thank you. Hi guys. So I'm Amber. I'm from the Cumbria Wildlife Trust and currently working on a sort of relatively small scale one habitat restoration project. So forgive me because all of this is very, very new to me, but it seems like the drivers, as you said, there's sort of the voluntary involvement that is for the good of nature, effectively, or at least appearing to be for the good of nature, and then there is the much more robust, we have actually a vested financial corporate interest because it's related to the things that we do and it's going to benefit us directly. And that's what you were saying was kind of the actual thing that people will invest in. That can sometimes be at odds of why we as conservation organisations and as people in the conservation sector do the restoration work that we do. So how would you, in the sectors that you're in, advise going about highlighting the value of these sort of ecosystems and seascape restoration projects to financial investors, to potential investors, without sort of compromising our own sort of reasons why we're doing them? Basically, should we be saying, we're championing this and we're saying you should finance it because of this one very specific thing, the nature-based solutions, and that's why they're important, or at the risk of kind of sort of ignoring all of the other reasons why we as conservation organisations would be restoring them? There's all of these other reasons why it's important to restore these ecosystems. Do you think that they should be left off the table completely, or should we still be bringing them to people who could be financing it but maybe aren't interested in those other reasons?
So I think this comes back to a point that Sophus made as well, which is about there's certain things that you need a revenue stream. When you're talking about investors, you need a revenue stream. to be approaching those investors. That revenue stream then needs to be coming from either credit or one of the business models that I put up. So I would say if your objective, your discussion there is that to get that in private investment flowing, you need to be focusing on the revenue point, the risk return profile. But the wider reason to do the restoration, the wider issues that are being solved, that is the piece around those other philanthropic sources of funding, government funding that should be directed at that. And I don't think there's any problem with setting it in a wider context to say, this is all of the reasons and the issues that are going to be addressed. This is the thing we're bringing to you as one slice of that. Just, to contextualize it in that. To give you an example, we see in a lot of our work, and the right finance in the right place or the right funding in the right place. There is a role for government funding where there's not the ability to commoditize it, or there's not going to be that return profile that private capital would be seeking. And so making sure that you're presenting the full package, I think, is of value. There's no reason you need to hide the rest of that or downplay it, but obviously what's going to motivate the different audiences that you're talking to, you should focus on those.
Yes, it's a beautiful question. Yes, the textbook answer is different people respond to different motivations, and so having a plethora of values in your project that you can sell to anybody, right? I don't mean sell, I mean like to share your enthusiasm with under any different value system is great. I talk to a lot of people in your situation. The thing to really chew on here is, do you want to make your money from a compensation market where your revenue stream is coming from a destruction of nature elsewhere? And what I normally encourage wildlife charities to do is actually not to enter the environmental markets at all. Try and use additional finance, philanthropic or member-based finance, to deliver conservation that is additional to what is just a mandatory requirement. Because if you don't, no one else will. So this is the danger with compensation markets. You lock your revenue streams into compensation markets, you create the political economy for more harm to nature.
Yeah, I would just echo what both of you guys have said. And I think, there's no reason you can't kind of report on all of the benefits that you're seeing. Sort of our plan in the long term is when we develop these credits, within it will be called a biodiversity credit, biodiversity certificate, but you'll be able to look at what all of the other work that's happening at the same time, the community engagement work, the nutrient mitigation work, some of the carbon work as well. So all of that will be in the story under the umbrella of the biodiversity credit.
Question for Caroline. With the Crown Estate being like the owner of the seabed and selling leases to extractive or damaging practices, why not charge more for those leases so you can fund nature positive? And if you can't do that for some reason, why not withhold those leases so you're not complicit in the damaging?
It's a really good question, and I think it's important to say that as an organiser, so I've been with the Crown Estate for nearly 3 years, and in that time it's been through some significant change. I think there was a new strategy that was adopted about 5 years ago where they looked at reviewing all of the things that you've talked about because of the importance of the foundational underpinning of everything that happens in that seabed space by the natural assets that sit across it and that are supported by healthy and well-functioning seabed habitats. We are absolutely not in that space yet. We do not have well-functioning, resilient seabed habitats across all of our seabeds, so there is much to do. And we're working quite hard with a lot of partners, lots of who are in the room today, to understand how can we do that? What are the financial levers that we can pull if that's the right levers for us? Where can we be sure that we are no longer allowing activities to happen because they're incredibly sensitive or incredibly vulnerable, whatever it might be? And then in terms of financial flows, how can we play our part to direct money towards things where it's very difficult to secure either investment or philanthropic funding for whatever reason? Are there some gaps somewhere that we can help to kind of push money towards because we have levers available to us that perhaps others don't? So it's a really good question, and I would encourage everybody to keep challenging us on that because we've started our journey in that space, but there is definitely more to do.
Thank you. I was really struck, Sophus, by the proportion of markets that can even be tapped into for nature positivity, and nearly all of our financial markets are based on nature destruction. So my question is, rather than markets changing, does not the finance system need to change in itself. And isn't that would be and I would just like your thoughts on that, because that sounds maybe like an idealized solution, but I would really like to hear some people's thoughts on that.
I'll have a start at this. Okay, so in the research academia on biodiversity finance, we draw this arbitrary delineation basically between greening finance and financing green. Financing green stuff, financing good stuff. Greening finance, that means changes in financial institutions that basically make it less profitable to damage nature and more profitable not to damage nature. This is, in my opinion, where all of our emphasis and action should be. It's not, unfortunately, where I work, but I'm trying to get more into that space, because I've now, after 10 years, identified that I think that's the question. And there are amazing people who do stuff there. People like Professor Nicola Ranger at LSE do amazing work on this side. And basically, you've got a bunch of approaches to how we green finance and make it less profitable to damage nature. I mean, the current, so that the easy option is you basically make financial institutions report on their impacts, and that's the classic approach that we're kind of going down now, or that the EU is sort of walking back on that. And the idea here is that if financial institutions and companies report on their impacts on biodiversity, then investors will take that information and they will reallocate capital away from damaging industries. I have a lot of skepticism towards that view, and I don't think, for example, it's prevented a huge investment in fossil fuels over the last 5 years. But that is, I'd say, the conventional mainstream financial response to this. There's other really interesting aspects that I'm paying attention to, things like what we call precautionary financial policy, which would include, there's wonderful work going on at UCL, for example, to look at globally critical ecosystems in the climate system. So they take, for example, Indonesian peatlands and the Amazon rainforest, and they'd work out, so who's financing activities that are causing deforestation in Indian peatlands and the Amazon rainforest? And actually, they've published that kind of work. And JP Morgan Chase is the largest international financer, non-domestic financer, for example, of activities that cause deforestation in the Brazilian Amazon, for example. So then the question is, can we implement financial regulations that basically just ban people from investing in or change the incentive so it's much less profitable to invest in stuff that damages nature in places where nature is really important to global public goods or global systems. So that's where the frontier of the research is yet. Generally, financial supervisors don't like intervening in finance, partly because it's very complex, so you never really know how the financial system will respond, partly because the financial lobby is very, very powerful, so there's all of these dynamics going on. But basically, yeah, I totally think you've identified where the question is. The research frontier is in that direction, and now, I mean, it's a pure political economy dogfight about who it is that should regulate the financial sector. Should it be a central bank, so a financial supervisor, or should it be government policy? These are interesting and active questions. And then in the case of government policy, how can a government do this in a way that doesn't undermine its international competitiveness? So those are the big sort of frontier questions. So yeah, I mean, this is exactly where I think everything should be going. Basically, I mean, the history of capitalism is that it has expanded to the detriment of the environment for 200 years, whilst achieving massive improvements in living standards, right? And now I think it's reached the limits of what it can do there without a major overhaul in fundamental incentives in the economy that mean that it's profitable to destroy nature and unprofitable to restore it. So that is the challenge of the 21st century, in my view. Yeah.
And just to add to that, I think there is a bit of global shift thinking happening around this with the Global Biodiversity Agreement and the framework that the UK signed up to, most of the countries in the world have signed up to. They've committed to identifying what the harmful subsidies that they provide to nature are and repurposing those to tune, I think it's 500 million every year. And, you know, that's a big step. It's not a legally binding document by any means, but it does show that they're starting to think about and identifying the fact that providing subsidies that harm nature is probably not the way forward. And there is a way that we can start thinking about repurposing those. In my opinion, in more exciting news, the World Trade Organization has come to an agreement on fisheries subsidies provision. If they get enough signatories, you won't be allowed to provide subsidies to fisheries that are overfishing, fishing in the high seas, IUU fishing, all the things we shouldn't be doing anyway. Those will not be allowed. And that is a legally binding agreement. So when that happens, and again, I think there's this perception that, you know, that's livelihoods, that's jobs, that's food security, but it's by no means that money isn't going anywhere. That money will still be there. The whole thing is to repurpose it towards building back fish stocks, building resilient coastal communities. And so there is a bit of education to be done on removing these subsidies. Doesn't mean that money disappears and goes somewhere else. They can be repurposed to support those same livelihoods and food security in a much more sustainable way.
Yeah, I mean, I'll just add, in terms of some of the levers that you can pull as well as around that redirection of subsidy, but also making the finance more expensive. So that any financial institution can say, you know, their interest rate for investing in carbon fossil fuels, for example, would be higher, and then they would give lower interest rates to projects that are showing, you know, sustainability impacts. So there's levers that any financial institution can implement. It's a matter of whether they're motivated to. And that will need to come through regulation around reporting, but also around regulation related to targets that the financial sector needs to meet.
Thank you. I'm Ollie Hicks, a director of a regenerative aquaculture business. And a really interesting panel because you represent the private sector, the public sector, academia, and philanthropy. We operate a blended finance model with our farms effectively. We really are reliant on impact investment, philanthropy, grant funding, research. That's fine to a point, but it's not ultimately sustainable. We do have a commercial model based on turning kelp into fertilizer, which may help carry it. But my underlying question is, we've heard that the regulatory markets look like they're going backwards, away from sustainability. I think I agree we need a mandatory, we need policy to be mandated that people have to price nature in. Do you see across the markets a good news story? Do you see anything coming down the road through regulation, through policy that is going to open up either for pure marine restoration or for blended finance projects like us?
So basically, again, biodiversity finance, investment that is good for nature, spans a lot of different stuff. We've got the stuff that attracts for-profit investment into protecting and conserving and restoring nature. And that stuff looks terrible at the moment. Really terrible, in my opinion. Really bad. We're rolling back on lots of the demand drivers for that stuff at the moment. I think that looks terrible. But there's a whole bunch of stuff that gives me hope. And it's all on the technological innovation side. So there is a lot of business models emerging that are good for nature, either because they substitute for, so they outcompete stuff that's bad for nature and they are better. Sounds like your business is one of those, right? Or because they're deriving like technological improvements that greatly increase the efficiency of production processes and reduce inputs, etc. And those things are also relatively small relative to capital markets, but there's some great and highly scalable stuff in there. And that is where a big chunk of my hope lies. And I think there is finance available for sustainable aquaculture. I mean, it's exactly one of these categories of completely, of potentially sustainable, so self-sustaining business models that can definitely operate in this space. And there are impact investors, and if you're able to deliver market rates of return, right, there are also growth investors that would be really interested in those kind of things, and they definitely are good. I'm really glad those businesses exist. They're definitely good for the environment, but they are not protecting or delivering nature conservation or restoration. There's a separate category of stuff, and those things are not doing well at the moment.
Not a lot of reason to be optimistic, probably, but I think things like the TNFD, the Task Force for Nature-Related Financial Disclosures, these reporting standards that are coming out, where we are now hoping, and they're obviously voluntary, they're not mandatory at the moment, but companies now have a way to look at what their nature risks are, what their nature opportunities are. They have other frameworks to look at what steps they can take to kind of protect their natural resources that their supply chains rely on. There are ways emerging, and nature, which has been sort of ignored behind climate for quite a long time, is coming into the conversation around what you look at as a corporate within your corporate sustainability reporting. And I think that's quite positive because it at least gives an avenue to start kind of reflecting inwards on what impacts that you're having, what are the risks, what are the opportunities, and that's where conservation can kind of start showing up, being like, hey, we can help you kind of mitigate some of the risks that you can foresee, because you can foresee what the risks are to your financial risks going forward. So frameworks that help increased transparency and visibility within what the nature impacts are a positive light.
I mean, your specific question around favorable policy or regulation, I think, is a tough one in the US, certainly, and in the UK. Maybe a bit more positive in Europe, New Zealand. There's some positive pockets, I guess, in terms of where policy and regulatory changes are happening. Beyond that, I would say there's a general support, I've been building off both your responses actually, around supporting tech and enterprise development. So I think where you have a technological solution or an enterprise that is solving a problem or reducing a risk in a supply chain or creating resilience, then there is a kind of natural fit to wade through this period where there's a bit of resistance to nature or climate just for the sake of nature and climate.
Totally see that, Elizabeth. I think, sorry, we'll take it offline, but everyone wants to put money in tech, but no one wants to put money into nuts and bolts. And obviously marine restoration is fully nuts and bolts. And just, yeah, tough gig.
More challenging, yes.
I guess I would say that, yes, it is a tricky, this is my personal view, but it's a tricky kind of policy time right now. I think it'd be lying if I was kind of saying otherwise, but I wonder if there is hope that we can take from the momentum that's happened over recent years, and also we now are in a place where we have quite a lot of good examples of demonstrations of how things have been done slightly differently through either nascent or emerging or in some cases established nature market mechanisms that we can carry through this perhaps difficult policy period to give us some momentum into the future when hopefully a bit more sanity prevails. So thank you so much. Please thank my panel.
Thank you very much to Caroline and the panel for that really open discussion, and that's actually one of the most honest discussions I've heard about this, so well done and thank you. I'd just now like to introduce the CEO of ZSL, Matthew Gould, who's going to finish day one for us with a few words before, but yeah, don't knock him over on the way to the wine, that's what I say.
Thank you. I don't know if you're saying that people will be more interested in the wine than my standing here pontificating at enormous length. A massive thank you. I mean, first of all, to our partners in organising this, the Universities of Portsmouth and Edinburgh. We've been really pleased to work with you. Secondly, to all our speakers and panellists, everything I've heard today, I haven't been in everything, but I've been in a lot, has been brilliant, and the quality of discussion and the honesty the practicality of it has been a joy. And then thirdly, just a quick thank you to the ZSL team who put it together. And this isn't a complete list, so apologies to anyone I'm forgetting, but Celine and Harriet and Alison and Linda and Georgina, thank you very much indeed. And more winner. Now, I think I get to close day one because I literally know less about this than everyone else in this room. I share Sophus's fantastic and infectious enthusiasm when he bounded up to say how much he'd enjoyed it and how much he'd learned. I've learned a lot, and I profoundly agree with the comments from the panel earlier that with the best will in the world, unless companies, the economy is compelled through requirements, unless we are driven by compliance, I think we're only going to be tinkering at the edges. And I wish it were otherwise. I wish that simply doing the right thing for nature or responding to the concerns of consumers was enough. But I profoundly don't believe it will be. So I do therefore believe that engaging with government, engaging with policy and creating the right framework in regulation and the economic drivers is absolutely critical long term. But it is also the case, as was just discussed at the end of a panel, that this might not be the best time in the world to get the global and national policies that we all want to see. Which means, I think, that we as a community of people who really care about this issue and this set of outcomes are going to need to be able to operate at different altitudes in the coming years. We're going to need to be able to do the science that's going to underpin the conversations, provide the evidence, and drive the whole thing on a really sort of scientific basis. We're going to need to be able to do pilots to show and test what works and what doesn't work. And that means having the honesty to admit what doesn't work rather than just saying everything's been a fabulous success. We're going to need to drive what progress we can with what tools we can in the absence of the framework and the regulations that we want to see. Because if we just wait for the framework for government policy to be everything we want it to be, we will be waiting potentially quite a long time. And while doing all of that, we need to be engaging with the public, creating the right set of attitudes and understanding and political drivers so that long-term change, that policy change, can be driven from the bottom up. And that means we're going to have to speak to people other than each other. It means we're going to have to engage with the people who are causing harm, as well as the organisations that share our values and goals. It means we're going to have to build alliances, some of the usual ones, but also some of the unusual ones. And that's why I'm really pleased that this conference has been organised. It gives this community a chance to get together, to build alliances, to speak to people working in the same space who we might not already know, and the drink straight after I stop speaking will be a good opportunity for that. But we need to get beyond this community. We need to engage widely so we can drive the change at all those different levels I've mentioned, so we can try and achieve some of the things we've been talking about. So thank you very much for being here. Thank you to the organisers, and I'll see you at the drinks.